you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. And today I have the legend, the star of YouTube, the #1 realtor extraordinaire, very intelligent man, my best friend, colleague, Todd Sachs with us. Todd, how are you, sir?
Travis, I'm doing great, man. You're too kind, and you're a great friend. So I'm happy to be together. I love our opportunity when we can share the screen, and thanks so much for having me on your channel.
Todd, I definitely appreciate you. Before we really jump in, I want to, explain how appreciative I am to you, Orlando, Luke, even Scott. Scott's a little bit sick. You guys have been, helping me through this trip, man. I can't tell you how lonely it's been. I'm doing this whole thing solo. So, dude, just having friends and people that support you that are genuine, I can't tell you how much that means to me. So I just thank you so much, Todd, for being my friend first and foremost. But today, you guys, sorry, I don't mean to get sappy. Today, what we want to talk about is how, we're seeing a bunch of articles, how the mortgage rates are plunging, inflation's under control. It's time to celebrate. The Fed's just going to cut rates. And I really want to get Todd's perspective and kind of compare how the rates going down slightly, they're still in the 7s. It doesn't really stop the bad stuff from happening. So, Todd, can we just start by getting your perspective on, are we headed to the soft landing?
Travis, I would have expected that the recession would have already been here by now, but I still think that the minds of the consumers right now going into the holiday season, I think they're still in spend mode, even though they're putting things on their credit card and not really paying down their debt. But I think it's finally showing up, and the proof is in the data. And I think somewhere around mid-October is when it really started to show up. And we can tell a lot about what is going on with the economy based on things like trucking. And trucking, truckers are slow right now. I mean, they're doing layoffs. Trucking companies are going out of business. If things were great, we're moving into the holiday time, we would be seeing they would be thriving. And then, we both follow Danielle a little bit, Danielle DiMartino Booth, and she had I just watched one of her podcasts where she was at a convention for the trucking industry, and they were talking about chemical sales being really low right now. And as we know in manufacturing, I didn't even think about it really. I'm in the housing market. I'm focused on what I do every single day. But if, then I started researching about how chemical sales are really low, which means that production, manufacturing is slow. And I think everybody's kind of expecting to roll into 2024 with some really tight budgets.
Todd, what I'm saying, man, I understand the optimism, but the optimism, that foolish, even reckless optimism, it's kind of plays out the same way, at least the last crash that we were in. I mean, literally the exact same way, where you have the bulls and you have the bears. And something that worries me a little bit, and I know we don't have a crystal ball, Todd. We're looking at P ratio, affordability, our experience, 20 years in the business. You've been in the business longer than me. And, it's a little bit frustrating to see bulls claim victory, take this victory lap when we're still in the front end of a recession and still really in the front end of drastic unhinged unemployment. So can you tell the viewers, since you were in the business back in, the great financial crisis, do you see a similar sentiment from the bulls, right before the financial crisis that we're seeing right now? Do you see a similarity there?
I think the difference, or one of the similarities, and just to address the optimism that you speak about, there are very few people that look at data. They watch the headline news. And I think that, we're really being, shoveled a bunch of crap, as you know. I mean, when you see that the headline news are saying things are great and there's a soft landing and all this stuff. They're not, and people are just, they're dependent on that. But
Yep.
what they don't know is that these people come out later and say they were wrong, or they say, you know, they had corrected their numbers and it wasn't as strong. And that seems like an accepted, you know, type of occurrence. So when they're talking about the job numbers and then they come back and they, you know, update that, you know, weeks later, it's just not, by then they kind of just slide it under the rug. So the data comes out, they tout about it, everybody thinks everything is great. Then the new data comes out and they don't tout about that. So I think, you know, we're going to find out we're in pretty bad shape. You know, as far as consumer debt, the government's in debt. The government put themselves in debt. The government's in debt because they help the consumers get into debt. So, but the similarities are, you know, what I only know what I know. And that is working in the business every single day, like you, Travis, that's talking to buyers and sellers and commenters and following the data. But I can tell you that 2008 wasn't that long ago. And the way I describe it is this: I don't care what happens right now with the Fed lowering interest rates. When they did it in 2007, when Bernanke, you know, Ben Bernanke, however you want to say his last name, people say it different, but when he was the Fed chairman at the time, he said that the banking industry was strong. He said that the housing market was strong. Right before Silicon Valley back in March collapsed, you had Powell saying the same thing. He testified to Congress saying that the banking industry, there was no indicators that there was going to be any kind of failures. And then weeks later, we have a disaster on our hands. So I think, and I'm not saying that they're doing it intentionally, but they're not, obviously, somebody's not looking at the data, right, at the highest level. But here's what I know. I know that consumers are really burned out. Mm-hmm. And nobody knows the affordability crisis worse than the ones that are in debt. And that's a large portion of Americans. So when you're paying, you see your credit card going up every month, it's not coming down. And now these banks are kicking you in the teeth and they're charging you, you know, penalties and late fees and the worst interest rates we've ever seen, right, for credit card revolving debt. When we're seeing, you know, borrowers that took out home equity lines of credit and now they're really struggling because they wish they would have had that paid off before the rates doubled and almost tripled on that. So because they're fluctuating interest rates on these types of revolving loans. But here's the thing. Everyone now knows that we had the largest and still do the largest real estate bubble that we've ever seen before. That's undeniable. That is undeniable looking at the pricing data. You say PE, right? So when you look at the prices to earnings and we're looking at home sales that you need I just did a video, 7.5 or 6%.
Yeah, 7.4.
Or times is the multiple to median income to be able to buy a house. When we're used to 3 and 4% over the history of time, maybe 4.5%. So it's almost doubled that. You need to, really go into debt now. Most people just can't even afford it. But here's what happens. And this is what happened in 2008. When the market's going up, Travis, and you know this, when the market is going up and we're trying to beat the top. If you're a buyer, what do you want to do? Let's just use the list price in a climbing market, maybe 2021. Let's use the list price to keep it simple of 500,000. In a month from now, it would be 550. So in today's offer, the buyer wants to give them 525 because they want to beat it before it gets up to 550 next month. So they give a little bit more, right? Because it's a climbing market. They want to beat the climb and not get penalized for waiting, right? They'll pay a little bit more today because they know in a month it's going to be a lot more. The same happens in a declining market. When the market's sliding down, buyers are like, oh, the market trends turned. I want to wait. I'm going to let it cool off. And the smart money, the ones that are really in the market that can afford it, they're sitting back. You see the comments, right? In your channel, my channel, they're sitting back and saying, I have the money, I've been saving, I'm waiting to see what the market does. So now the opposite is happening. People want to offer what they think is going to be next month's price or the price 6 months from now, because in a declining market, they want to beat it. So, I don't think that and I could be wrong, but I don't professionally believe at this point, I think we're too little, too late. We hit the tipping point, in my professional opinion. And if they drop rates right now, that people are going to still want to see price corrections.
Todd, you said some really great things there. A couple things I wanted to point out for the viewers is, I like how you basically, some of the things I gathered is basically the people at the top trying to understand what's going on, policymakers, those are rich men and women, okay? They're not in debt like consumers, so you can't really expect them to relate. And then I'd also argue that they are intentionally distracting us. They are intentionally not telling us what's happening next. And I also want to bring this point up. People are like, when the rates go down, buyers are going to flood back to the market. And that's, and I had to think about that. That's a fair concern, right? Lower rates, buyers come to the markets. But then I started thinking a little bit deeper, Todd. And the thing is, rates have already gone down in new homes. New construction, we already have, Todd, 4% interest rates. We already have 5% interest rates. And yet the price went down $30,000 in 1 month, down 17.6% from October's peak, which is year over year. And the supply is going up, 7.8 months of supply. That's a buyer's market. So we see, that rates, although they do matter, and I'm not saying that they don't matter, but again, the prices, the bubble, the PE ratio, that's all so important. And I like one of the, I was listening to a podcast that you did actually with Luke. He sent me a podcast that you guys did. It's not even out yet because I was driving through the mountains and I was like, Luke, my man, talk to me, brother. I'm barely hanging on. So he's like, here, watch this podcast with me and Todd. And, you brought up some really good points. And, when we really understand the sentiment and the fear of missing out and how emotional buyers were over the last 3 years, it really starts to make sense that there will be a correction in, I would say, almost every market. And the thing is that, and I love that you said this, people only purchased in 2020 to 2022 because they thought they had to. There was no inventory. So I would say a large portion of those people, Todd, settled. They settled on a house they didn't want. They overbid, appraisal gaps, no inspections. So, what happens, Todd, if you can explain to the viewer, obviously this is not like the stock market. And by the way, good video you posted as well with the Simon Black, I think it was.
Yes.
Simon Black.
That's his alias, yeah.
Unlike the
James
stock
Hickman.
market, James Hickman. Unlike the stock market, Todd, a couple sales in a subdivision, because everyone, the bulls say real estate's local. Well, let's keep thinking on that, mindset. So local, it's generally about subdivision unless it's rural property. 3 sales and you're out. 3 comps, 3 homes, it could drastically impact the value of houses. So what happens, Todd, okay, in your professional opinion, as my colleague and friend, what happens, let's hypothetically say, and I'm not saying they're going to do this, but I just hypothetically, if rates go down next year, say third quarter, let's say mortgage rates go down into, say, mid 5%. Do you think, and let's say there's no unemployment, what do you think happens?
Well, again, you said it. It's the price to earnings. The fact doesn't change that the interest rate is low. The fact doesn't change that we're almost 8 times median household income for the price of the home. And you know as well as I do that nowadays buyers on average only stay in the home for 7 to 9 years. And the younger generation, probably less than that, because they're used to moving around so much in college. I mean, some students move every year. So, so they get into a spot where they overpaid and they're remorseful now. They, like you said, they wouldn't have selected that house, but because it wasn't any inventory, the fear of missing out was real. I mean, we both have heard Barbara Corcoran say if the rate has a 5 in front of it, that we could expect to see home prices go up another 10, 15, 20%. She says, I think what's going to happen, Travis, in my opinion here, is that, and we're not really dealing with a inventory shortage. We're dealing with the fact that a lot of people own more than one home, and we were waiting for inventory to get completed. We're in some of the highest inventories for new construction. And I think that if they drop the rates, what that is going to do is going to spark the sellers, because the sellers are going to think to themselves, now's my chance. I have a pent up demand of sellers right now, Travis, at work, where they want to wait until spring, hoping the rates are going to come down so that they can pounce on putting that house on the market. Well, what happens when you get all of this inventory like we haven't seen in years, all of a sudden in a couple month period, because they're going to be quick about it. I mean, the minute, let's say they drop rates, you see, the bond market collapse, which is hard to imagine, but let's just imagine it. The 10-year treasury goes back to 2% or something, and we can see 3.5%, 4% interest rates again in the mortgage side. Do you have any idea how many sellers are going to be panic selling to get to the point of like, man, this may not last for long? Today's the day. All of the Airbnb hosts that have been struggling because of rising costs, man, you're going to see, I mean, it's going to go nuts. The warning is that, and Luke and I talked about this too. The interest rate may drop, but if your salary doesn't go up significantly to keep up and to get those home prices, the PE ratios back down to at least 5%, the cost of the houses, every repair you're doing is going to be based on the inflated cost of the house. Because unless we start seeing home prices decline, new HVAC systems prices aren't going to decline. New roofs aren't going to decline in prices. So you may get a good rate, but wait till it's time to fix that house.
Yeah. And then you got property taxes that are elevated now because of the run up. You have homeowners insurance that's elevated. You have probably 8 million buyers right now. They're upside down in their house. When you really look at the cost to sell a property, commission, closing costs, these people are upside down. And Todd, I've heard stories and read reports that people are getting divorced right now, but staying in the house because they cannot afford to sell their house and move somewhere else. So we got people that are desperate. And I'm so glad you talked about that. I also believe, depending on, I asked okay, what do you think is going to happen without unemployment? But with unemployment, everything that you just said is enhanced. Because again, if rates go down low, you're going to have probably 1 million sellers trying to sell their property. They've been on the sidelines themselves for the last, 2 years? And when we talk about supply and demand, which is really a big point of the bulls, even though they talk about it in a vacuum, like it doesn't change, the prices are being propped up by two things. The government bailouts, okay? If they didn't do the bailouts this year, we would be talking about deflation right now. We've already had deflation this year. So I don't know why so many people are surprised what we're saying when we've already seen systemic failure. So again, if we get double the inventory from these sellers and the prices are being propped up from the limited inventory, then the way that supply and demand works is, so long as the demand is under the supply, the prices will go down. This is nothing new. Why, Todd, with the bulls, why are people acting like prices never go down? I don't, that's one thing, like Dave Ramsey, dude, he and I don't want to, talk smack about him. I know he's helped people help themselves out of consumer debt, but I also know he's highly leveraged on his channel and on what he does with real estate industry sponsoring him. So he has to say certain things, but I believe what he's saying because he's being paid to say that. But what is your take on when you hear someone like Dave Ramsey say that home values have only gone down in 2008, and then also dig into the fact that, generally 10-year cycles, real estate goes back up. The danger is getting from one cycle to the next cycle if you're a normal consumer upside down in their house. job loss, unaffordability. Can you talk on that stuff, Todd?
Yeah, Dave Ramsey talks about being out of debt, which is not a bad thing. We agree on that, right? I mean, I think that the banks, for the most part, you don't want them in your life, and people are seeing that firsthand. People are really seeing it on the commercial side. They're seeing where the banks are ready to take their assets that they've been struggling to own, and these are real estate investors. A lot of them own the businesses that are inside. They're owner occupied investors, right? So they have an office building where their office actually is inside it. Yeah. And, the banks are coming back and wanting, because they're struggling, they want their money, and these banks are going to take these properties. So we want the banks out of our life as much as possible, in my opinion. I don't think these people know what they're talking about so much that are like, leverage. They're going to see what that means real quick, because a lot of people saw what it meant in 08. But as far as, when you're talking about prices going up, we have to consider the dollar, the adjusted inflation to the dollar, and we have to look at the PE, like you've said. You can see where home prices are going up and trading at multiples that are even getting more and more higher compared to the median pay of households. If there's no wage growth, there's a tipping point. And when that tipping point, in my opinion, starts to come down, it's going to come down like we ain't never seen before, right? I don't buy into the fact that everything goes up. The other part is a home is a depreciating asset. It is not an appreciation that happens. Land prices go up, which is really critical in location. So many people bought in the wrong location. They bought the wrong lot that nobody else is going to want because they can't cut the grass, or it's next to the highway, and they bought into it thinking they'd never get a house, and they'll take that one. Man, when this starts to hit the fan, everything is going to matter. The cliche of location, the cliche of buy low, sell high is where you want to be. You don't want to be at the top of any market, in my opinion, when you're buying. But a house falls down around you, Travis. It is that the only reason why on the commercial side, the IRS allows for you to take depreciation on the house if you're a landlord is because the IRS acknowledges the house falls apart. The only way that they don't let homeowners take that same tax cut that the investors get. Right. I mean, that's kind of bad, too. Right. How can you, from a investor standpoint, depreciate your house, but you can't as a homeowner?
Todd, I get all that, man. But, what I'm really trying to figure out, man, is we got people watching us and we want people to make up their own minds. We don't want to do the thinking for anyone else, but we want to help educate the consumer. Todd, my point is like when we have consumers listening to this great man, great men with all of these accomplishments, they own way more than me. They've accomplished financially way more than I can. But when they're saying that, again, going back to Dave Ramsey, home values only went down one time in 2008, even though we have data showing home prices went down in 2007, 2009, 2010, the Great Depression. It went down in Houston with the oil. It went down in Houston in 2015. Do you think that he's saying that because he's sponsored, Todd?
I don't know. I mean, I think that I don't know.
So maybe he's stupid. Do you think he's just stupid? Or do you think he really believes what he's saying?
I think he believes what he's saying. I think that, look, I mean, Dave Ramsey doesn't make the decisions for me every single day when I get up and go to work. He doesn't hear the conversations that I'm hearing. I don't know if he's helping buyers or sellers or not, but I mean, the sellers that I'm talking to, they are having a realization that they missed they believe that they've missed, not because of me. A lot of them don't even know that I podcast and that, I educate them when I get there, but I ask them what their opinion is of the market. And a lot of them say, I'm just hoping that I can get out. I'm hoping that I can, pay off the loan because I need to move. And so, I mean, I think that a lot of these cheerleaders they're disconnected. I mean, Dave Ramsey's got a lot of money, man. I mean, I think he falls into the category that you said earlier, that, you know, some of these people that have a lot of money, they don't talk to the people necessarily or deal with the people's lives like you or I do, or somebody else that's helping a buyer or seller navigate this market. They don't want to hear, oh, don't worry, just go. Listen to how this sounds, Travis. Listen to how this sounds. If you don't buy now, you're going to miss your golden opportunity. I know you don't have a deposit. I know you don't have a whole lot of money, but we can ask the sellers for some help. You know, we can get you in this. You can refinance later when the interest rates drop. I know you don't have 6 months of cash in the bank, and it's 3 times the amount of the place that you're leasing, and that your utilities are going to go up 4 times because now you've gone up in space, you know, in the square footage. And I know you're going to have to buy things like a lawnmower and a snow plow in some areas, and you're going to have to pay for things that you never had to do, like everything. But don't worry, if you don't do it right now, Travis, you're going to miss out.
Yeah, I don't like it.
Does
Todd.
that
It makes
sound good?
No, it makes my skin crawl, you know, and I know that I bet you a lot of people that are saying that have never went through a foreclosure, repo, bankruptcy like I did. And honestly, like, it caught me by okay. It was my own bad decisions. Okay. I made bad decisions during the great financial crisis, but essentially I allowed myself to get caught blindsided. The only way that I learned that house values are going down and to be cautious was I had to lose everything, Todd. But we don't want people to lose everything. So Todd, please, if we can shift this conversation on to what, in your professional opinion, someone that's out there being cautious, what can consumers be doing right now, Todd, to get a better understanding of what's going down? Because they are probably confused, probably a lot of anxiety. You got these people over here saying one thing, you got other people over here saying another. What do you think people should be focusing their time and attention on that do want to buy a house, Todd?
I think that they should be really concerned about their job. So I think first and foremost, they should really make sure they're securing that employment as much as they can. You know, I don't think now's the time to shift companies, to jump ship and go to another company necessarily right now. I think I would have a really good relationship with the people at work. I would be doing my job the best that I can. And then I would really be saving as much money as I can. You know, I would personally, and I am, I mean, I'm cutting back, you know, forget about, you know, things that aren't necessary. I mean, we're coming into the holidays. The last thing I want to do, I want love to be the forefront of the gatherings in the holiday season. And that's the way it always is with, with my family, because, you know, I don't want people to go into debt buying me things that I don't need, just because they feel like it's important to do so. You know, so think about, if you're going to spend money on the holidays, you know, really look at what you can make, or sometimes baking somebody a cake is more important than buying them $100 shirt or sweater or something.
And
so,
cheaper.
It means a lot, it means a lot more. But I think that we need to get back to the basics. We need to control our debt. We need to save money, because, you know, if the market does shift, we don't have crystal balls, but if it does shift, you'll be in a better position to capitalize and take advantage on the shift in the market. But I don't tell people not to buy a house. I try and educate them, because some people just aren't going to listen to what you say anyway. They don't listen to their parents. They never have. They don't, they do the exact opposite. So I think that what I try and do, and what you try and do, is educate people on what's going on. Try and bring the data forth of what could happen. If you've bought houses before, have at it. If you see something and you can afford to overspend, if overspending is in fact what you're doing, go get it. If you're a first-time buyer, I think that you should be utilizing more caution than we've seen happen in this industry in the last 3 years.
Yeah, I mean, I would argue, Todd, that some of these investors are in worse shape than the first-time home buyers, especially when it comes to the short-term rental bans, like in places like Dallas. A lot of these landlords can only cash flow, STR. They can't cash flow long-term. And it's also very interesting to me that a lot of those people are realtors. The realtors are the ones that are buying like more and more and more Airbnbs. I see it all over my social media. Now, let me ask you this. Let's shift gears, Todd. I asked myself this question. I want to stay sharp. I want to make sure that my viewers understand that we're stress testing what we're saying, because what I'm learning, Todd, is there are bad people on both sides of the coin. And I don't want to bash people that are bullish, that have perspective and genuinely feel the way they do. If they genuinely feel the way they do, I appreciate the perspective. I analyze it. I stress test, right? But then there's also people that are just saying things based on emotion. And that's on our side also, Todd. There's people that are talking about the crash and they're only talking about the crash because that's the only way they can get leads generated. And I'm not, all I'm saying is, I appreciate you. I appreciate all the boys, man. I'm blessed to have you guys as a group. You're all are genuine people, and we really love each other. But this is my question, and I asked myself this. Okay, I believe that if the Federal Reserve does nothing, the economy is going to crash. The housing market is going to crash. It is a fact. It is a fact. But I still ask myself, and I'm asking you now, Todd, and I'm asking you now, under what conditions can you see us making a soft landing? How do we get to a soft landing? There's really only one way I can see that being possible at the expense of kicking the can down the road. But what do you think? Is there, how do we get there? Do you even think it's possible?
No.
What about
I don't think it's possible at all. I don't think a soft landing is possible. I think not having a landing is probably more possible than having a soft landing.
Okay. Then how do we get there? Talk about how we get there then.
Yeah. What I think will happen is that they're going to print more money. And I think that there will be in a position where we're going to need more bailouts and we're going to need more stimulus and we're going to need I think what's going to happen here is I think business owners, they have targets on their back. I hate to say it. If you're self-employed, they're probably going to be coming for you to collect as many dollars as they can from you because they need money. And I think we're going to see a transition where the middle class is just going to the money's just going to get sucked out of them to make up for some of the deficit moving forward. So, that's just my personal opinion. And it's been said before, this is nothing new. But I think if you're not a W-2, they're going to be eyeballing you, man. They're going to be coming for every penny that they can get. So, do I think that a soft landing is possible? I think that what they need to do is just let the economy sort itself out. But that's the way they used to do it prior to the 80s, 70s, and 80s. They just let the recession happen and it sorted itself out. And we were back on track. We had our normal corrections. Markets expand and contract. So they bubble. And when they bubble, if you don't, by extending the pain, which would be much shorter, by extending it, they allow it to continue to inflate.
Yes.
So if they would just let it pop, we wouldn't be looking at anywhere near the home prices that we're looking at now. The affordability would be great. The other thing, Travis, is, and I'm a real estate investor. So I say this, I'm more into the commercial assets than I am into the residential assets, but I've been a landlord for 25 years. I've been getting rid of my properties because they're weaponizing the tenants against landlords. I can see the writing on the wall. And I was the type of landlord that didn't raise rents. I signed a lease with people, and as long as they stayed in there, they didn't get a rent increase. It wasn't until, they moved out or till recently where we're like, well, we have to get a raise in rents because now we're in the negative. So, which doesn't take much, believe me, in landlording residential properties to be in the negative. Mm-hmm. But anyway, what I think is that the landlords out there right now, a lot of them are just getting out of business. So they see the writing on the wall. But I think we're going to print and give stimulus.
Yeah, we're seeing rent soften as a primary result, unaffordability, and then obviously the supply. One of the things that really shook me, especially about Denver, Todd, was the amount of current active building of apartments. So, when I look at the soft landing narrative, I mean, I agree with you. I really can't see a soft landing, and it's really even hard, Todd, for me to see a soft landing, even if they do bail out, even if they do print, because the only way other than keeping your job, so bailing out will probably strengthen the labor market. But unless you're doing what they did during COVID, where they're injecting the consumer with this money in their bank accounts with stimulus, I really don't think that the bailing out is going to help buyers. I think actually it's very possible if they continue to kick the can down the road, that it's actually going to hurt average Americans and it's going to hurt buyers. But again, the only way that I can see any type of soft landing or just no landing at all, they're going to have to prop up the market, and that's not really a good thing at all. Todd, can you tell me what happened? Can you tell me?
Go ahead.
Can you tell me what happened back in 2006 when the Federal Reserve cut interest rates to what was it, under 1%? It was right around 1%. Can you tell us what happened when they decided to cut rates back then?
We had the crash. It wasn't enough. It was too late. I mean, and that's what I think because of the sentiment. So what we're seeing right now is, before I say this, I just want to say I believe commercial is really in trouble. All these multifamily buildings that you're referencing. I mean, there's calls for earnings from these operators that are trying to raise more money, and they're losing money, and they're thinking about their loans are up. They're thinking about selling the assets for 30 cents or 40 cents on the dollar already. I mean, I know people that have been involved in these calls. But anyway, so that I think multifamily is in big trouble. Yeah. But my background is in construction, as you know, and I've built houses, renovated houses, been through land development processes, developed land for myself, help others go through it, developed commercial real estate for quite some time. I mean, I started in 1989 as a contractor, working for home builders, Travis. Working for home builders. So
you're trying to get that bid, right?
Working for home builders.
Yeah, and they nickel and dime you. Didn't they nickel and dime you trying to get the cheapest labor?
I was burned. I mean, I was burned hundreds of thousands of dollars through the years. Just crazy, right? Builders.
Yeah.
Stop working for them. Stop working for them. I had to. I mean, bad reputation, right? Paying their bills. A lot of them. But it seems that in every single solitary housing market recession, it starts first in new construction. So if you want to look at what is happening to the home market, you have to look at what's happening with new home construction. They had the worst October in price declines nationwide than they've had in 20 years, right? Their price declines actually dipped below the price declines that they had in the great financial crisis. You can look the data up. You know it. So
and Todd, real quick, Todd, I want to tell the viewers what Todd's talking about. Median sales price decline again, October to now, but that's not counting sellers' concessions. When we add the sellers' concessions to that package, Todd, brother, the values went down more than $30,000. Some of these rate buy downs that they're offering through Lennar Mortgage cost $20,000, $30,000. But the reason why they get away with this is technically, even though Lennar owns Lennar Mortgage is not the seller. So therefore, that credit is not considered a seller's concession. But you and I and anyone that has any type of reasonable knows that Lennar owns Lennar Mortgage, brother. This is and then not to mention the shadow inventory, the lack of reporting, the lack of transparency. I didn't mean to cut you off, man, but you get me so excited when I talk to other people that understand it starts with new construction. Well, it starts with interest rates. Then it sells for existing and new construction. We've already seen a sales crash. We're seeing price crash, new constructions. The next thing is prices and then inventory. I'm sorry, Todd. I've been driving solo for a long time, brother. I didn't mean to interrupt you. By the way, Todd, I got roasted for the one I did for my collaboration with Orlando because I talked like 80% of the time. And I remember after the collab with Orlando, I was like, brother, I'm so sorry for talking so much, but it's like I was lonely, Orlando. I listened to 20 hours of YouTube videos. I needed to talk. And
it's
you know
your
what?
show, man, and you can talk as much as you want, bro. Look,
You know,
you
I just
bring
really
the value.
appreciate you, man. I just really appreciate you guys, man. It's so rare to find genuine people that, they get your back. And not only do we get each other's back, we call each other's out on our BS. Not that it's a lot, but to have people that even stress test you, that would be one thing I would encourage people is just to filter what you're listening to, get all perspectives, but understand that on both sides of the coin, crash or moon, there are people on both sides of the coin that are manipulating you for a reason, for profit. Todd, continue. I'm so sorry, brother.
Yeah,
I love you, man.
Travis, to bring that, to just kind of add to that, I mean, part of the reason why we have such a tight community and that we are friends is not so much that we agree with each other, but we know that we have a genuine care for other people. And it's easy to read through a lot of the other, BS when you can tell that they don't feel the same way. I mean, so I commend you every day. I mean, what you're doing going out on the road right now, sacrificing time with your family, spending money to, quitting your full-time job, to hit the street, to believe in what to take serious what you're trying to get out to people, the truth that, you're trying to just bring, hey, you know what, I've got nothing really to gain here. People think, we make, all this money because people are watching our videos. I mean, come on, man. I mean, what you're doing is trying to prevent people from making catastrophic mistakes and bring value. And so I appreciate that. And I mean, the same thing with Scott and Orlando and Luke and, Steve. We don't see Steve podcasting much anymore. I think he burned out a little bit. But again, real estate broker in Florida. But, getting back to the fact of the new construction is, and so we'll talk about two things real quick. Number one, when a builder builds a community, they build it to sell unless it's a build to rent community. Because if they take and get into a spot where, then they turn their community to rentals, they kind of harm the people that have bought into that community that's now full of, not that I'm saying that rental houses are bad, but you don't have necessarily, you have different forces. You have an imbalance, right? So what happens is they build these houses to sell. The lots they develop to sell. So every day that they're not selling them, it's getting more and more negative for them. So they're trying to cut their losses early to avoid the losses later. So when we see them making these, they're big enough to stand the test of time. So when they're saying we got to keep things going, there's no reverse gear in the economy with that. When they're moving along with that, they got to keep the sales going, right? Flip those dollars, or their shareholders are going to get really nervous and their stock prices aren't going to be good, right? People will be pulling out and selling their stocks. So it's a bureaucracy. But the other side of that is, man, what you mentioned earlier in my conversation and with one of my guests, Brent Johnson. No, it wasn't Brent. It was James Hickman. He talked about here's how pricing happens in real estate. And you said it with comparative sales. We could go out and buy 50,000 shares of Apple.
Yes.
Today, or sell it. And we're really not going to move the needle, you and me, right? Not that we can afford to buy 50 shares.
Right.
Let's just say you go and buy 30 shares or, 50,000 shares, 30 shares, right?
Yeah. Yeah.
You're not going to move the price of the stock at all. But yet in a neighborhood, one buyer can move that home price stock, if you will, up and down based on their willingness or not willingness to over or underpay, right? So for instance, if I have a house and I look at it and I'm like, man, I love it. I'll give you have it at 500. I give you at 600. I just raised the stock, if you will, to 600 is the new price. Everybody else is like, whoa, what did he just do? He just raised the price $100,000. The same goes in reverse.
Yep.
The seller says, man, I got to dump this property. I have equity and I can afford to dump it. I need to sell. I'm getting called out of town. I've got an ailing parent. I need to move closer, whatever. Man, they dropped that price $100,000. They just sold their stock essentially.
Yep.
And moved that needle. Now, like you said, you get that happen a couple times.
Yeah.
Well, you've just recalibrated the housing market just like that.
And Todd, I want to explain to the viewers a little bit more specificity on how value is calculated in the front end of transactions, which everyone knows it's done by an appraisal. But the appraisal is done by using traditionally 3 comparables sales, or three properties that have sold in the subject properties subdivision. So a lot of times they'll, the most weight of the comp, as long as it's equal characteristics, is going to be the newest comp, right? The newest comp is generally, not all the time, but generally you're going to put more weight on the newest comp. So if the newest comp is a distressed seller, then an appraiser is supposed, they won't always do this, they want to maintain relationships with lenders, still, even after the GFC and after it's a felony, but they are supposed to take the most recent comparable and put more weight on that. Again, depending on how different the characteristics are. There are adjustments made based on characteristics like square footage, obviously lot size, you know that. But again, value on the front end of real estate is calculated by what 3 other houses have sold for recently. So it doesn't take much. And the thing, Todd, is it's hard to rebound once that starts, once that sentiment changes, once people realize, oh, the house market is really going to crash. Once we figure out, well, actually consumers could never have afforded this to begin with. Interest rates on credit cards are 30%. Every area of debt, of consumer debt, has delinquencies that are surging past pre-COVID, minus conventional mortgages, maybe USDA and VA as well. Definitely not FHA. FHA is spiking. But I mean, that's really what we saw in the GFC. It's not about subprime. And I always said that, and I love how your similar sentiment, but similar comprehension of this. But we didn't have a GFC because of subprime, and that helped the problem. That helped people get in more debt. The reason why things fell apart is people stopped paying their mortgage. They could no longer afford it. We had a job market that deteriorated. Consumer delinquencies skyrocketed. It crushed regional banks and mortgage lenders. They all went out of business, and this domino effect happened. So again, I really feel like people need to understand. Primary reason why the house market rebounded so strongly this year is, yes, we understand that there was buying demand on the sideline. We understand there was a lack of foreclosures. We understand there's a lack of supply. But please understand that there was also a bailout this year. And that bailout prevented massive layoffs. The Silicon Valley Bank was a bank of companies, of tech companies. And that's another thing. They were not supposed to be refunded their money, Todd. They bailed out the rich people, not people like us. Remember, FDIC was only supposed to bail out $250,000. There was companies that got bailed out $500 million. Again, the rich got bailed out, not the consumer, but the sentiment changed at that moment. I remember the sentiment changed because I remember leading to March. We had year-over-year decline on a national average. We had massive price declines. We had inventory at 4.7 months going into this year. Banks started having those bank runs. Government came in, changed all the sentiment, stopped, deflationary stuff. And I understand, Todd, it's hard to get what's going on. I have a special perspective because I've been in the industry so long, so I've seen these cycles, but I've also have a special level of empathy, being that, and people want to talk down on me all the time, like, why are you listening to this guy? Because he's had a foreclosure, bankruptcy, and repo. Well, I'll tell you this, okay? Having those things, it taught me what not to do. So even if I don't know what to do, thank God I know what not to do. And Todd, one thing is how I'm not going to do. I'm not going to buy an overpriced house. And it's not even just an overpriced house. People have a double whammy. We look at the PE ratio, but then when we look at the payment to income ratio, which is another set of data, that's as bad, it's worse than GFC. We have unaffordability of the 1980s, brother, and an asset bubble bigger than the GFC. Unless we all make 62% more income, I don't see another way that this can sustain. In fact, I'm a little surprised it sustained this long. And honestly, in that surprised, I've really it's depressing seeing the game being played. And going back to the beginning of this, I believe that what Jerome Powell is saying, and then back to Ben Bernanke. I mean, I think they're just trying to keep us calm so they could boil us alive. Not for one second do I think that they're not smart enough to understand that they cannot be honest to us. I prefer the honesty, Todd, but I have faith in people. I have faith in people like, hey, give us the news. We're not just going to freak out. We need those hard truths. We earn those hard truths so that we can adjust our lives accordingly. And that's exactly what I did. And anyone that's depressed on the sideline, like Todd, we are getting paid 5.3% to wait. So it's not the end of the world. If you want to buy right now, it's 52% more expensive. Take your down payment, 70, 60, 70, whatever, thousands of dollars, and go buy. But what I'm saying is it's a little reckless. It's a little reckless. And I feel like it's a big danger. It's a big danger because, again, like what you were saying, everything has been propped up by emotion, by fear, actually, by bailing out, PE ratios out of whack, payment to income ratios out of whack. The thing is, and we haven't even started recession. So, I'm going to try to wrap this up, Todd. Man, I just want to say this real quick, and I want to give you some last words here. Man, I am so proud of you. I'm so proud of everyone. I'm watching you grow, man. I just want to say you earned it, man. The cautious approach and perspective that you bring, and you just maintain your humility, and your realistic, perspective, man. It's just such an honor to know you, Todd, and it's such an honor to watch you grow. Same with Orlando. So proud of Orlando. So proud of Luke, Scott, everyone. But can you end, Todd? People right now, I think they're confused. I think they just want to figure out what to do next. Can you end on hope? A realistic hope for consumers. Can you tell people, just end on some consumer hope? What hope is there to hold on to if we're saying that, yeah, everything's out of whack, but the government can continue to kick the can down the road? Where's the hope there, Todd?
The hope is to, number one, start by not judging other people. And the people, Travis, that you referred to that judge your walk and, what had happened to you in the past. I mean, really, I equally commend you. Everybody makes mistakes, man. This isn't easy. I mean, it's like, parenting, like nobody gives you a playbook, right? So, you chose a path of self-employment, and it's not an easy path. Being an entrepreneur isn't easy. And a lot of us, we go through some battle wounds. So I think just the fact that, you will come out on the other side. And I think that you can attest to that. So no matter what you think you're going through right now, today, no matter how hard it may be financially, we know that, financial pressures are the number one, culprit for divorce, for, drug use, alcohol use, how we go into self-destruct mode because the pressures of financial pressure really can seem like there's no way out. And we've all been there, and I've been there. I mean, everybody that wants to do something that wasn't handed something with a silver spoon in their mouth has fought and struggled and made mistakes. So, look, nobody should be judging anybody, right? But I think the hope here is that no matter how bad it is, you can get through it. And, you based on your faith, your love, stick together, huddle. A lot of things were meant, in life that to do by yourself. Survival's not one of them, right? So having good friends, having good, family wrapped around you, the people that love you the most, that you love the most, it's the time to, if you're going through a struggle, it's a time to huddle, and then you can think objectively. And if you have to let things go and start over, man, no big deal. Don't sweat the small stuff.
I love it, man. And another thing humans aren't supposed to do, Todd, is go on 16-day road trip solo. I'm paying for that now, man. I mean, people are like, oh, who cares what you're going through? You're taking vacation, like that maniac on your channel. I don't remember what his name is, but I'm like, oh my God, I wish this was a vacation, man. I mean, this is This is some hard shit. And honestly, man, I just quit. I'm in the strip for $5,000. Yeah, I'll be happy if I break even, but again, I couldn't see, for example, Boise. I saw on paper like the massive price declines, but when I go like to New Home Source, Lennar, and I'm like, I don't see a lot. I know it's dropping. I know the unaffordability, the P ratio is like over 8, by the way, in Boise. So like I get the unaffordability, but where's this coming from? So, but when I got there, man, and even Denver and Salt Lake, you can't put into words. It's very difficult to put into words when you go there and you see it for yourself. The boots on the ground perspective has been like, whatever your perspective is, just multiply it by 3. Because not only am I seeing I'm just seeing so much more construction that's going on that is not being reported on New Home Source, not being reported on the census data, not being reported on MLS. It's just there. It's the wild. It's almost like commercial financing, which is the wild, wild west. There's no consumer protection. I look at it very similarly in the new home department. It's almost like there's no consumer protection. Part of the contracts of these new home styles, so it's not just a slam dunk to buy a new home. Part of the contracts is the arbitration agreement. They put in that special warranty deed so they can't get sued. That's so scummy, man. I mean, stand behind your product.
Do they look alive? I mean, when you're looking at these communities, I mean, do they have sales flags flying? I mean, do you see people driving around and coming in through?
Well, so first of all, every one of them has flags because they want to bring in the business. But what I'm saying is okay, there's drastically different, because remember, housing is localized. So we have to go so local. We're talking about subdivision. There's different levels of distress per subdivision. Some subdivisions that I found, Todd, dude, where was this? This was in Salt Lake. There was a subdivision, just massive, massive subdivision, hills of all this development. And they may have completed 10% of this subdivision. And they got all this other construction. I'm just looking like, holy smokes, all these people that just bought. You have a mud pool right now. The park is not even being done completed. We're in the front end of a recession. But then there's other subdivisions. Like when I got to Reno, I went to one of the first places I went to Reno was it was a Lennar community. It was like a closeout sale. So they cut a property price $200,000. But that subdivision is almost completely sold out. So that's a different level of distress. That one is going to be a little bit stronger based on the ownership, right? But the other ones that they have no choice but to cut prices because of the spec homes, those are all over the place. Every single metro area, surprisingly, including Reno. I thought Reno would be tight. And it started off that way. I'm like, yep, this is what I thought, And then I went to, can't remember the name of the subdivision in the area. And I was like, holy smokes, they just made a town, an actual town right next to, right outside of Reno. And dude, if I'm in Reno, really anywhere, even if it's a tight market and I want a great deal and I want to see what's going on, you got to look at the subdivisions that have the excess building, that have the excess spec homes. Unfortunately, it's very difficult to find that minus walking it, driving around and seeing it. So these guys are trying to sell, man. But again, if their rates, they're advertising, Todd, they're 4 or 5%. The rates have already dropped. And that's what I'm trying to explain to people. Everyone's like, yeah, the rates are going to drop next year. Everyone's going to win, right? Well, not in the areas that already have new construction. The areas that already have new construction, we've already had low rates for the last year. And
they've been buying them down two points.
Price is still going down. Inventory is still shooting up. That will spread over within a certain amount to existing home sales. It's going to spread over, especially if those existing home sales are right next to these new build communities. I mean, the existing home inventory, those sellers cannot compete with these people unless it's a short sale. So, man, go ahead.
You said that one community, they were closing it out and they were dropping the home prices $200,000. So to me, that's a big alarm, Travis, because the last few houses in the community should be all pure profit. You shouldn't be giving away those. I mean, usually they hold firm on the last houses. They don't give them away. So that's telling a bigger story in itself, in my opinion.
Yeah. It was such a nice area, man, right tucked into the mountains as well. And it was honestly, it was the only house that was listed on Lennar website. It was like a quick clip. I'm like, okay, here's the 200,000, this is probably a closeout. But I mean, I guess what I really appreciate about what we're trying to do here is we're really just trying to sharpen up people. We're just trying to get people to just think a little bit, get to the amortization schedule, get to the new build communities, boots on the ground, start to think on your own, right? Start to be independently thinking. One of the things that scares me, Todd, and I say this all the time, I absolutely do not want to do this. I don't want to do other people's thinking. I think that's toxic. I think if people allow other people to do their thinking, then they're never going to grow and they're never going to learn. So this is a hard truth, maybe I'm saying, but I do not want people to hang on to every word that we say. I think that's bad. I think that's unhealthy. I think it creates an echo chamber. By doing so, you're not able to make sure your opinion is adjusted and refined. So, but on the other hand, man, we are so blessed. These people, a lot of the people on YouTube, they're very smart, intelligent viewers. They're not letting us do the thinking for them. We're basically leading them to the data. We're leading them to additional perspective. And it's such an honor, to be able to provide that cautious approach. And again, normally real estate's perfectly good, Todd. We're both in real estate. We love real estate. I never said I didn't love real estate. I love it. But right now, it's just so dangerous. It's just not even worth touching, in my opinion. So other than that, bro, any last words, Todd?
I appreciate you, man. Thank you for having me on your channel, and we'll have to certainly get you on our channel to talk about your trip when you come back, and maybe do a quick synopsis and break it down, for our audience as well. And I'm excited to see your content.
Well, I appreciate that, man. I'm looking forward to coming home to do that.
Sounds good, buddy. Well, we'll
All
be
right,
talking to each other real soon, I'm sure, like tomorrow or today.
Yeah, we'll probably be talking in a couple hours. But all right, guys,
Right, exactly.
Well, other than that, guys, if you're out there investing in real estate, we wish you luck and we hope you win.